Welcome back. You're with us on Trading Hour. Let's welcome in Trideep Bhattacharya of Edelweiss AMC into the conversation now. Trideep, thank you for joining in. The year is still young, so let me wish you a happy new year. Hope it turns out to be a really good one for you and those at home and at work. So tell us, 2024 is telling us that we can't expect that straight line rally that we saw in November, December. It isn't that easy. But what's your overall stance and, what is the positioning on the equity side as we get into the year?
Wish yourself and the entire team Happy New Year, and thanks for having me on your show. Yeah, I think you are right. Actually, in my opinion, 2024 is a year of multiple transitions, actually. I'll talk about 3 or 4, which will likely cause good amount of volatility as the year goes along. I think the first thing is we'll move from economics to geopolitics. With about 50% of the top 20 nations heading for national elections, I think we are headed for a fairly noisy macro, whether it's election promises or geopolitics with regards to wars and thereabouts. I think the second transition that we'll make from a macro standpoint is from inflation to disinflation. While inflation has been rising in 2023, we will see some sort of disinflation coming through as the year goes by. And the third one that I would talk about is that global growth rate will actually bottom out in calendar year 2024. So we'll start probably with weakening growth rates, and as we end the year, it'll be on the rebound. CY25 could be a rebound year globally. So with those sort of transitions, which are fairly kind of heavyweight transitions in the way, the least that you would expect is volatility, which is what you are seeing right now. And trust me, none of what I talked about has even started. So you'll probably start seeing this from the end of the year, from the end of the month standpoint.
Trideep, this market, making money in this market is all about picking the right stock, right? Not just getting the sector right. Now, in IT, technology, something that I look closely, in the last 1 year, if you had bought Infi, you would have made 5%. But had you bought, say, an HCL Tech, you would have made 40%. And had you bought some of the mid-cap IT names, like a Persistent, you would have made close to about 90%. Or a Scient, you would have made, 180%. So it's all about picking the right stock. Tell us the themes that you like, firstly, and in those themes, how do you pick the right stock? Which is the, what will drive those outperformers in that theme?
I think great spot. I would, in my favor, I would argue that our portfolios have been by and large overweight mid-cap IT and underweight to practically nil positions in large-cap IT. That has kind of helped us getting the stock selection right on IT. And I would say that with such noisy macro, the only way to make money in such markets is to focus on those areas where we think earnings are likely to be resilient. And the 4 or 5 areas that we think earnings are likely to be resilient, the first that I would point out to is CapEx, which is an ongoing theme. Overall, with capacity utilization of 76.5%, I think CapEx over the next 2 or 3 years will remain buoyant, driven by private sector CapEx on the other side of elections. The second area that I would point to is power. I think whether we like it or not, as we head towards summer, we are heading towards a meaningful power deficit. And given ESG and concerns like that, capacity has not been added over the last 10 years. So we will see meaningful amount of power deficit as we go along towards summer. And hence, stocks in the power supply chain would actually have their time in the day. The third area that I would point to is real estate. In my opinion, we are in the middle of a 5 to 7 year upcycle, where overall the first leg is kind of broadly done. The ancillary sectors, which is where you have tiles, you have building materials, those kind of sectors might actually tend to do well over the next 2 or 3 years. And finally, I would call IT services as a dark horse of the year. Earlier I talked about bottoming out of growth rates in CY24. So as we look through the year, some of the stocks will be positioned quite nicely heading into CY25. So those would be the areas that we would be kind of pointing ourselves towards in our portfolios as overweight positions to make money in this otherwise a fairly noisy macro year.
And you would stick with mid-cap IT, or would you now look to make some more money from large-cap IT this year?
I think the blend between growth and valuations so far has been in favor of mid-cap IT. But in some cases, as valuations kind of leave less for discomfort, we will probably move on to other areas. But on the whole, I would still bet on mid-cap IT because some of these companies, and I can't get into company specifics, so some of these companies are positioned in such a way that they play on the areas that might rebound faster than a broader IT landscape.
What would those areas be, Trideep? I mean,
So for instance,
I know you can't name companies, but the niche IT plays or the niche areas where you think investors are going to reward growth.
so the second derivative play on artificial intelligence, the second derivative plays on SaaS as a player, and overall, at some point, maybe towards the back half of this year, a second derivative play on bottoming out of financials globally would be certain areas that I would look to as points of or pockets of turnaround with regards to numbers as a year goes by.
Okay, got that. Well, that gives us some clues. So, second derivative, AI, SaaS, and even good old BFSI, if that decides to bottom out in the US. Good talking to you, Trideep. Thank you very much for joining in, and we look forward to more conversations during the course of the year. You have a good day. Well, with that, we have to turn our eye back to the market.